Hi, I'm Brady Thomas with LaSalle Mortgage. In this quick video, I'm going to help you finally understand how escrow or impound accounts work and whether you should have one on your mortgage. Now, I know this topic can sound confusing or full of jargon, but don't worry, I'm going to keep this simple and clear, and it'll only take a few minutes. If you're watching this, you're probably at the point where you're finalizing your home loan or need to decide whether or not to set up an impound or escrow account. Or potentially you've seen it listed on your loan estimate and just want to understand how it actually works. I've been a mortgage lender for 15 years and I got tired of seeing home buyers get tripped up on this topic. So I made this video to explain exactly how I think about escrow and impound accounts. All right, let's start with the basics. An escrow account, also known as an impound account, is a separate account that your lender uses to collect and hold money for property taxes and homeowners insurance. Instead of you saving up and paying those big bills once or twice per year, your lender collects a small portion every month. It's roughly 1/12 of your annual taxes and 1/12 of your annual insurance, along with your mortgage payment. Then, when those bills come due, your lender pays them on your behalf. You can think about this like a piggy bank your lender manages for you. It's your money. They're just holding and distributing it when needed. Now, depending on your loan type, you may or may not have a choice. If you're doing an FHA, VA, USDA loan, or you're putting less than 10% down on a conventional mortgage, you're required to have an impound account. But if you're doing more than 10% down on a conventional or a jumbo loan, you usually have the option to decide. Lenders generally love impound accounts because they get to hold your money for several months without having to pay you any interest before using it to pay your property taxes and insurance. If you think about it, across thousands and thousands of borrowers, that's a lot of money that they can keep, invest, and grow. So, what are the pros and cons? The big advantage is convenience. It's a set it and forget it system. You don't have to remember to save up for those big property tax bills that hit twice a year or your annual homeowners insurance renewal premium. For many homeowners, that's peace of mind and they love it. On the other hand, some people prefer to keep and control their money, especially if they have money market or investment accounts that earn them a good deal of interest. They'd rather hold on to those funds themselves and make the tax and insurance payments directly when due. That's perfectly fine, as long as you're organized and disciplined about saving for those expenses. When you set up an impound account, there's no fee to create it, but your lender will collect a few months worth of taxes and insurance upfront at closing. That's because they need a cushion, sometimes called an escrow reserve, so that when your first property tax or insurance bill comes due, there's already enough in the account to cover it. Each year, your lender performs an escrow analysis to make sure they're collecting the right amount. If your property taxes or insurance go up, your monthly impound payment might increase slightly. If they go down, you might get a small refund, or you'll see your monthly impound amount decrease. It's also common for borrowers to feel like they're paying twice in the first year, but that's not actually the case. It's just how the timing of the closing overlaps with the upcoming tax and insurance bills. This is especially true with your homeowner's insurance. When you buy a home, you typically pay the first year's premium at the close of escrow. That's required because the insurance must be active for the loan to fund. At the same time, your lender will pre-fund your impound account with a few additional months of insurance so that there's enough on hand for future payments. After that, a portion of your monthly mortgage payment still goes towards replenishing that account so that your lender can pay your next year's premium when it comes due, which is usually months 10 or 11. So it may feel like a double payment up front, but in reality, you're just prepaying to set up the impound account so everything runs smoothly going forward. The most important thing to remember, the money in your impound account is still your money. If you refinance, sell your home, or pay off your mortgage, whatever is left in that account is refunded directly to you, usually within a few weeks of closing. So, to recap, an impound account is a simple way to make sure your property taxes and insurance are always paid on time, automatically. It's convenient, reliable, and totally optional for many borrowers. That said, if you're doing FHA, VA, USDA, or a loan that requires less than 10% down, you have to set this up. Sorry. Whether you choose to have one or not really depends on your personal preference and financial habits. If you found this helpful, make sure to check out the other videos in this playlist where I break down each part of the mortgage process in plain English so that you can make smarter and more confident decisions as a homeowner. Thanks for watching.